In 2026, Ireland cut the tax on ETFs for the first time in over a decade, from 41% down to 38%. And if you invest here, you probably heard that and thought, finally, some good news. But here's the uncomfortable part. The rate isn't what makes this tax brutal. The thing that actually punishes Irish investors. They didn't touch it at all. Let me show you exactly how ETF tax in Ireland really works now, because this one rule changes everything. Hello, I'm Wealthy in Europe. Welcome back. Quick note before we start. This is educational information only, not financial advice. This one's specific to Ireland, and tax rules change. So treat everything here as an explanation of how the system works, not a recommendation, and always check your own situation with a qualified advisor or on Revenue's own website. So let's start with the good news, because there genuinely is some. Ireland taxes most ETFs under something called exit tax. And in Budget 2026, brought in by the Finance Act, that exit tax rate dropped from 41% to 38% on gains, the first cut in more than a decade. That applies to your typical Irish or European domiciled fund. The standard USATs ETFs most people here actually hold. A lower rate is a real, if small, win. 3 percentage points of your gains stays in your pocket instead of going to revenue. So far, so good. But a rate cut only matters when you actually pay the tax. And in Ireland, ETFs have a rule about when you pay that is genuinely unusual. And the rate cut did nothing to change it. It's called deemed disposal. And it works like this. Normally, with any investment, you only pay tax when you sell and take your profit. That's fair. You've got cash in hand to pay from. Deemed disposal breaks that rule. In Ireland, every 8 years, Revenue pretends you sold your ETF, even though you didn't. On that 8th anniversary, they charge you 38% on the gain you've made so far, in real cash, while you still own every single unit. You haven't sold anything, you haven't received a cent, but the tax bill is real and it's due. Then the clock resets. Your purchase price, for tax purposes, becomes the value on that anniversary, and a fresh 8-year countdown begins. Now, to be fair, you don't pay twice. When you eventually do sell for real, you get credit for the tax you already paid at year 8. But sit with what this means. You can be forced to find thousands of euro in cash to pay tax on a profit you haven't actually cashed in. Some people end up selling part of their investment just to pay the tax on it, which quietly breaks the one thing that makes investing work, compounding. And here's what makes it sting. If you'd bought individual company shares instead of an ETF, the tax would treat you completely differently. And better. Let me put them side by side. Individual shares are taxed under capital gains tax at 33%. ETFs under exit tax at 38%. So the ETF rate is actually higher, but the rate is the small part. With shares, the first 1,270 euro of gains each year is completely tax-free, every year. With ETFs, that annual exemption doesn't exist, not a cent of it. With shares, if one investment loses money, you can use that loss to reduce the tax on your winners. With ETFs, you can't. A loss on one fund can't shelter a gain on another. And with shares, you only ever pay when you choose to sell. With ETFs, the 8-year deemed disposal we just talked about. So line them up. Higher rate, no annual exemption, no loss relief, and taxed before you've even sold. 4 strikes. That's why advisors across Ireland keep calling this system unfair to ordinary long-term investors, and they have a point. Let me make this real. You might remember Maria from earlier videos. She did everything right, picked a low-cost global ETF, set up an automatic monthly buy, and left it alone for years. Exactly what you're told to do. Then her 8th anniversary arrives. Her fund has grown nicely. Let's say she's sitting on a healthy paper gain. She hasn't sold a thing. She doesn't plan to for another 20 years. But deemed disposal doesn't care. Revenue treats it as sold, and Maria owes 38% of that gain in cash by the following October. Maria didn't get a windfall. She got a bill for money she never received. If she doesn't have the cash spare, she may have to sell part of the very investment she was trying to leave untouched, right when she least wants to. That's the real cost here. Not the 3-point rate cut, the timing. This is the part of Irish ETF investing that catches people completely off guard. Now, two things worth clearing up, because people mix them up constantly. First, this is about you, not the fund's address. Deemed disposal applies because you are tax resident in Ireland, not simply because a fund happens to be Irish domiciled. Plenty of investors across Europe hold Irish domiciled funds and never touch this rule. It's Irish residency that triggers it. Second, you'll hear that accumulating ETFs, the ones that reinvest dividends automatically, are the smart pick here. And for one narrow reason that's true, it avoids being taxed on each dividend as it's paid. But be very clear, accumulating does not let you escape the 8-year deemed disposal. That clock ticks either way. And one more, those US domiciled ETFs Americans rave about, as we covered in an earlier video, you mostly can't even buy them here. And if you somehow hold one, the tax treatment is different again and genuinely complicated. That's a talk to a professional situation, not a follow a YouTuber one. So will this ever get better? Maybe. And this is where you need to separate what's real from what's just a promise. Back in 2024, the government's own major review of the fund sector recommended exactly what investors want. Scrap deemed disposal, bring the ETF rate down in line with shares, and allow loss relief. Good, sensible stuff. But here's what actually happened in Budget 2026. They cut the rate by 3 points, and that's it. Deemed disposal, untouched. The bigger reform was pushed off to a roadmap that was promised for early 2026, and at the time of this video, that roadmap has been delayed. So when you see headlines or other channels hyping a new Irish investment scheme, understand what that really is. A proposal under review, not a rule you can rely on today. The only things you can plan around are the rules that actually exist right now. So I'm not going to tell you what to buy or how to feel about any of this. Instead, here's how to think about it, so you're never caught off guard. 1. Know that in Ireland, most ETFs mean 38% exit tax and a tax event every 8 years, whether you sell or not. 2. Know that shares, pensions, and other structures are taxed under completely different rules, so the best wrapper is genuinely personal. And 3. Because reform is being talked about, check what's actually law before you make a big decision, not what's merely proposed. Those 3 habits will save you from the nastiest surprises. This isn't advice on what to do. It's a map of how the ground actually works. And once more, because this one really matters, everything here is educational information only, not financial advice. It's specific to Ireland, and tax rules change. So verify your own situation with a qualified advisor or on Revenue's website before you act. If this cleared up something the finance world tends to leave in the small print, hit subscribe. It genuinely helps the channel. Thanks so much for watching, and I'll see you in the next one.